Hey everyone, welcome back to 51%'s Crypto Research Podcast. I'm your host, Tom Shaughnessy. Today I had on Olszewski and Jose Macedo to discuss Ethereum's fat protocol thesis following Jose's post on the topic. We also go into everything Ethereum, covering Serenity, scalability, store of value, future use cases, and why ETH and crypto prices haven't yet bottomed. As an aside, visit 51pct.io and enter your email address for all of our extensive research reports. 51% offers sell-side research for crypto funds, traditional funds exploring the space, family offices, analysts, and professional investors. 51%'s research is invaluable to finding actionable ideas and institutional level research. Also, if you're interested in advertising on the podcast, email Tom at 51pct.io to explore the opportunity. With that, here's my conversation with Eric and Jose. Hey everyone, welcome back to the podcast. I'm your host, Tom Shaughnessy, and today I have on Jose Macedo and Eric Olszewski. I really messed that one up, but I'm going to let both of my guests introduce themselves and give their backgrounds. But the point of this podcast episode is to be a very conversationally focused episode on Jose's recent post, which basically defends the fat protocol thesis of Ethereum. I think that it was a great post, but I also think that there are some lingering concerns, and Eric, of course, is here to give his views on that, and I will as well. But before we jump into that, I guess let's start with you, Jose. Just give us your background and how you got started in crypto.
Hey guys, I'm Jose Macedo. I'm currently the head of advisory at Amazix. Yeah, before this, I guess, initially, so a few years ago, I was a professional poker player. I was decently successful at that. Then I went to university, started a few businesses there. One of which was sold to another company in London. And then I started in crypto about a year and a half ago when one of my friends introduced me to it. He introduced me to Ethereum, actually, and that's what got me hooked. Since then, I've just been sort of dived down the rabbit hole. I've put my companies on hold. I've got people to manage them so I can sort of focus on this full time. I started writing about it, started working for Amazix about 9 months ago, and I'm sort of head of their advisory service where we help companies with token economics and white paper writing and all portions of their ICOs offerings, I guess.
Super interesting. And Eric, let's switch over to you. Just give us your background, how you got started in crypto.
Certainly. So my background is in CS programming as well as electrical engineering. I got started in crypto a few years ago after I joined a small healthcare company, which was soon to be acquired by a company called Athena Health, which in itself was actually just acquired. It's going through an acquisition right now, amazingly. And while I was when I joined this small healthcare company, the code base that I was jumping on board was written by a contractor. And it was some of the best code I ever seen. So of course I started stalking him on GitHub. And started seeing the stuff that he's contributing to. I saw Ethereum. I talked to a buddy of mine about that and started diving down that rabbit hole. This is about 2.5-ish years ago. And we started building on it. It was pretty brutal. So we were like, let's build some tools for it. We built a company around it called Transmute, focused on, initially it was consulting, and then it went on to decentralized application frameworks and just general tooling. And now it focuses on decentralized identity solutions. And presently I'm focused on what's known as Committed, which is a company that focuses on bringing the personal touch to professionalism. So we're trying to make LinkedIn less sterile. But I also am a part of the Plasma implementers group as well as state channel researchers. So very big on scalability.
Yeah, that was super interesting. So I'm dealing with two extremely experienced entrepreneurs and successful ones, if anybody's wondering from their backgrounds. But let's jump right in. I want to get into Jose. I want to get into your post. I believe it was Joel Monegro who championed the fat protocol thesis. I really hope I'm getting that right. But let's go into, I guess, Jose, maybe a few sentences. What is the fat protocol thesis and why does it apply to Ethereum?
Okay. So I guess the fat protocol thesis comes from, Joe sort of draws a comparison between the value capture characteristics of the internet in the 1990s and blockchain now. And the idea is that like in the internet, the early protocols like HTTP, TCP/IP and all those, they created massive value. They're like the underlying basis that all the internet's built on. but they actually did a really bad job capturing this value. Most of them were open source, they had no revenue at all. Whereas what actually captured the value was the applications built on top of those, like Facebook, Amazon, Netflix, etc. So what you can think of that as is like a thin protocol layer and sort of a fat application layer built on top. With blockchain, basically, Joel argued that that could be reversed, and you could have a fat protocol layer with a thin application layer built on top. And the reason he said this was because protocols can be monetized through the use of cryptographic asset tokens, and they create a shared data layer, which reduces the sort of monopoly data advantages that current internet applications have. So that was sort of the thesis that powered a lot of Eth's bull run and a lot of the narrative around Ethereum as well during 2016 and 2017, this fat protocol thesis. And I would say around the end of 2017, but mostly since May 2018, since the price dropped, you've seen more and more people now pushing forth this thin protocol thesis, which is basically what the blog is about, arguing against that.
That's interesting. Okay, so Eric, I mean, I know this isn't too contentious, or it might be. I'm not sure. I didn't ask you earlier, but what's your take on the fat protocol thesis overall?
I mean, I'm a fan of thin protocols. I see what Ethereum's doing here, bundling a bunch of things in one place, and there are a bunch of other competitors which are coming up, and like Definity or Tezos and these other various smart contract platforms that are championing like potentially less fat protocols. I don't really have a big issue with it in terms of Ethereum. I think that, yeah, I'll leave it at that. There's a lot more to say here, and I'll wait until we get into a little bit deeper into the article.
Yeah, no worries. It's definitely it's a hard thing to convince longtime internet analysts or longtime observers of the internet about the fat protocol thesis, because they just see the valuations of the companies built on top of them, like Facebook and Snapchat, and they forget about the underlying technology. So that's what makes the thesis so interesting. So I guess let's get into, Jose, your first argument. And your first argument is regarding economic abstraction. So Ethereum Ether is not necessary to pay gas. And that's what some people say against Ether. So I guess describe this first point for us and what you mean here.
Yeah. Okay. So basically, what I did was I divided the blog into sort of three arguments, which are the main arguments that I see against the fat protocol thesis or for the thin protocol thesis, however you want to put it. So sort of the first argument that I addressed, which I think is sort of the simplest one to address as well, was initially put forth by Jeremy Rubin in his TechCrunch article, "The Collapse of ETH is Inevitable," which came like appropriately just as ETH was, crashing to the ground after the short thesis and from Tetris Capital and stuff. And what he says is that, to put it very simply, it's that Ethereum is not actually necessary. So ETH, the asset, is not actually necessary for Ethereum to function, because, and again, he gives the metaphor of Ethereum being a car, right? So the Ethereum network's like a shared car, and when a contract wants to be driven by the shared car, the car uses up fuel, which in this metaphor is gas, which you have to pay the driver for. And obviously how much gas money you owe depends on how far you had to be driven and how much trash you left in the car, which would be storage in that case. And so the idea that what he says is that the metaphor doesn't work because, gas is actually physically necessary to drive a car, whereas ETH isn't. And through economic abstraction, you could use other currencies to pay for gas fees, such as the ERC20 tokens, for example. And he gives his example of Buzzword coin. So I guess if you had to summarize the argument is, firstly, it depends on the premise that the value of ETH comes from its use in paying gas fees for decentralized computation, which is also an interesting one to discuss, I think, because it's sort of taken for granted in most of these articles, but there are a few reasons that couldn't be the case. And then the second is there's no reason for ETH to be used to pay gas fees, as through economic abstraction, any other currency can be used. Then rational, independent, and self-interested miners will choose to be paid in assets of their own choosing rather than in ETH. And then obviously the conclusion is there's no reason for ETH to be valuable, and the collapse of ETH is inevitable. So I don't know if you want me to get into the counter argument or if you want to discuss that argument a bit more.
Yeah, that's a great summary of your first point. Let's go to Eric first before we get to the counter argument. I mean, Eric, what do you think about abstracting away ETH or gas paid to miners to power the network for applications and such?
I think that it's something that really should be considered a little more by the community. I remember that there was this motion to be able to make Ethereum like compatible with the ERC20 interface, or Ether, sorry, compatible with the ERC20 interface a while ago. I haven't really kept up with that, but as we move into, proof of stake, there's this whole idea of like token velocity, which I think is kind of bogus, because you can very well stake tokens and create derivatives off of that and then pay people with those derivatives. And so, you're securing the network, but then you're trading around this asset, which may like basically be slashed and be soon worthless. So I think that, economic abstraction is something that I definitely agree with. I'll go over to y'all for more on that.
Yeah, no, it's an interesting point. I guess the main thing I think about if we were to abstract away the underlying Ethereum currency Ether, is that it just creates another pain point on the UX or the UI, which is already extremely difficult for users. But Jose, let's get into your counter argument there. I'm sure you have more to talk about.
I guess first thing is I do agree with that as well. I don't think it's a big deal either for fees to be payable in any currency, because I think especially once proof of stake rolls around, as you said, it won't have much of an impact on the actual value of ETH, which I think will be valued more like a yield asset, in that there will be a return that you get off the staked ETH. But I guess the counter argument for that argument is that obviously ETH is the only medium of exchange on Ethereum where the gas cost of transactions is 21,000 Gwei rather than 40,000 Gwei, which is a nearly half discount. And then obviously also paying for gas fees in Ethereum is built in and has no gas cost of its own. So there's no like tax. So really, if miners are truly, uncoordinated, disinterested, rational, like Ruben said, then there's no reason for them to not accept, to harm their own profits and accept anything other than ETH right now, obviously. And then I think if we consider the future roadmap as well, which is two of the proposals I discuss there, which aren't actually obviously on the roadmap, they're being discussed right now, but I think they're pretty interesting. Which the first of them is a self-adjusting minimum transaction fee, which is charged to the block proposer and it's payable in ETH, and it's burnt. And then the second is again a storage maintenance fee, which is like rent, and again it's burnt again. So both of these would basically enshrine the need to pay ETH at the protocol level. So basically, even if users could pay their gas fees in whatever coin, the block proposer still has to pay those fees in ETH, which are then burnt.
That's interesting. So I guess Eric, I want to hear your thoughts on what Jose is thinking about, but I guess just another point, probably a stupid question for you guys, but even if you were paying Ethereum's network fees in another token, doesn't that have to get transferred into gas at some point and paid anyway? So, even if you're paying in other tokens, aren't you really paying in gas? You just don't see it because it's abstracted away, or am I thinking about that wrong? I guess, Eric, we could switch over to you here.
Yeah, it all depends on if there's an adapter to be able to support that or not. Miners can do work with accepting whatever medium of exchange they desire. It's just that right now we don't have we don't have an adapter to make any ERC20 into like gas, right?
No, that's a good point. I guess, do you have any other qualms with Jose's counter argument on the abstraction or not? If not, we can move on. Not really. So there's an individual named Paul Stork who founded this company called TruthCoin, and it's a prediction market. And he was talking about this thing called drive chains a while ago, and he actually just recently released it. And he had a huge argument against side chains for Bitcoin. And the reason being that if there's a lot of value in these side chains, that basically you'll draw value away from Bitcoin, and Bitcoin will eventually collapse as a result of that, or people will be less incentivized to mine it. And so his idea with drive chains, which is kind of strange, is that you have side chains that are also mined by the main Bitcoin mining pools, so that and so like all the miners are in agreement. It's like what's valuable, and in order to mine these things, you have to be mining Bitcoin as well.
And this is also another thing. If you look at other example, like a more advanced proof of work, or further abstractions on proof of work, like Cadena's chain web, where they have braided proof of work. I see something similar there. And so, I mean, like, I agree that you should continue to pay things in a standard currency. Because when you start to have like heterogeneous gas, like like right now it's very straightforward. If you want to get a transaction through, you pay more gas, right? But like if there's somebody, if you only have that, right, or a basic attention token, and there's like 2 miners that are accepting that, then they could and then first of all, they have to be able to mine the block. I mean, like it just becomes a nightmare. So I'm not really in favor of that. I would say, like, if I would say keep everything standardized and maybe move over to a derivative from staked Ether.
Yeah, no, I would just like to see it. I would just like to see gas fees just priced in dollars everywhere. I just feel like that would make everything so much easier.
Yeah, that's an interesting proposal. Definitely with the drive chain. How does it? So how does that? Are the side chains still as efficient as they would be on a normal side chain? Because aren't the miners, the Bitcoin miners processing transactions, won't that defeat the point of the scalability of side chains? Or am I sort of misunderstanding?
So it puts a lot more bandwidth on all the miners, right? Because they're having to do even more work.
Yeah.
I mean, I can send you the article, or all the papers and stuff that he's written on, but he recently just started releasing them. Or he started like pushing things to production. I'm in agreement with you, but again, it's just another example to support the idea of keeping everything standardized and not trying to draw value away from the main medium of exchange.
That's interesting. And, two of the other things, Jose, you brought up at the end of your earlier point, is that if there's 2 proposals where the miner fee and the storage fee would be burned. And that's interesting to bring up because then you have impacts there. I mean, the velocity of burn tokens is 0, right? Because they're never changing hands because they're, locked in a smart contract somewhere. And then the other point is that would definitely decrease supply, and that would change, the early valuation models people are starting to work on, like myself. But, what do you think about that? Do you really think that these things should be burned? To me, it makes more sense for these fees to be distributed to, say, all the miners or something like that.
Yeah, it's definitely an interesting one. I guess the argument for having the burn is that it counters the velocity problem. So because as velocity increases, so as more transactions happen, you're having more burns, which, like, I think I put the equation at the bottom of the blog. That I use Vitalik's equation because I really like the way he's done it. But if obviously higher velocity normally will lead to a lower token price, but if you have a decrease in total supply simultaneously as the higher velocity is happening through the fee burns, then that'll have the opposite effect. And again, I'm not even sure how to begin modeling this. I actually tried for this blog, spent a few hours on it, but there's so many variables that aren't present in normal finance that it's really difficult to know where to begin with it, with the supply decrease and what price you're using, because you'd have to use something like trailing price probably if you're gonna, it's a bit of a mess. But
that's an interesting point. And I did a lot of work on 0x protocol, and I built a model out that deals with their velocity, and it took me like a week just to build a model. It took forever, but it came out good. But I mean, before we move on, Eric, what do you think about velocity with Ethereum? Do you think that, if Ether changes hands too fast, that the token won't accrue value, or what do you think about token velocity?
I think it's a buzzword. But I mean, like, it does have real implications. I mean, people have been going crazy about it. I mean, technically, like, if you look at the utility of a token, as velocity increases and as utility increases, as usage increases, you'd expect to see the value go down because there are more and more fees that are constantly being exchanged. I mean, I looked at the graphs that are a part of the post, and I completely agree with it. I think that, we were talking about this whole idea of the downfall of ETH and all of that. Like, I think that the price of Ether is going to be continued to be driven down. I don't necessarily think that staking is going to just drive it up. I would hope that there's enough value in the ecosystem that's constantly going around that it can support these much larger applications and much larger use cases to be built on top of it. And then you can argue, well, there's a fixed supply. And so we'll find some equilibria there, certainly. But I can continue to see, as utility goes up, that the price should go down. So, we'll see about that.
Yeah, that's an interesting point. I just wrote a Tezos or Tezos, however you want to pronounce it, research report for this month's report on 51pct.io, and I kind of compared the inflation rates of the two protocols and the requirements to be a validator. And I just find it crazy. Tezos literally has proof of stake out right now, and Ethereum will be there in a year or two. But nobody gives Tezos credit for any of this. It just doesn't make any sense to me. Do you guys follow Tezos at all, or no?
It's because of the legal stuff. They got off to such a rocky start that a lot of people just stopped caring, in my opinion.
Yeah. No, that's a good point. One person hold their whole protocol hostage, basically.
Yeah, I think it's probably something like that as well.
Yeah, that's it.
Yeah.
The inflation, like you're talking about, though, it's interesting to talk about because some people think that, like myself, that Ethereum is going to be at, 0.5% of inflation a year, and Tezos will be around 5.5%. But that has concerns. You either are overpaying for security or you're not protecting your network. There's definitely trade-offs there that are going to have to be figured out.
One thing that I forgot to mention about this whole token velocity business is that very few people take into account the fact that second layer solutions such as state channels and plasma are going to have tokens locked up for predetermined or indeterminate periods of time, depending on how much the participants that are involved in these second layer solutions, whatever rules they decide upon. And so we are going to have a lot of, for instance, with Plasma Cash, people are going to be exchanging tokens on Plasma Cash, but we're only going to see transaction routes getting put to Ethereum, and then getting stored on the Plasma contract on Ethereum. And on top of that, with state channels, you have a multi-sig between some parties. Maybe you have multiple multi-sigs and you can create virtual channels, but there will be a lot of velocity that goes on inside of these channels that it just isn't seen by the blockchain. And so I anticipate that there's going to be a lot of security bonds and deposits on the main chain, and that it's effectively going to use principally for settlement, in my opinion, versus and this is until we have something which is truly scalable. I think that's completely reasonable. And even if when we do have something that's scalable, I see people again having these little mechanisms to be able to continue scaling with higher abstractions, like with Plasma Cash. So,
no, that's interesting. So let's go off of Jose. Let's go off your post for a little bit and go back to the scaling that you bring up, Eric, because it's interesting. So, for those who aren't aware, Eric's describing in part where you have Plasma, which is basically an open network between two participants. You could do as many transactions as you want, and then you can close out on the main Ethereum chain eventually, or use it for security. So let's go into scaling for Ethereum. What do you guys think about layer one solutions like sharding and layer two solutions like Plasma? Do you think that they're realistic and going to happen, or do you guys think that the ETH Foundation just keeps moving the goalposts out and delaying? I guess, Jose, we could start with you here.
Okay, I guess this is probably Eric can give us some more insight on this, but just quickly on the velocity problem. One of the things I think I do think velocity has been slightly overstated, and it is a bit buzzwordy. But I think what it really brought to the forefront that was important is that the value of a network, but really of anything, is the amount of value that's stored in it. So if you do have really high velocity, what that means is that you need to have a huge amount of transaction volume to make sure that there's value stored at it, and then in any given moment, basically. So I think that's what makes it problematic, and what it means is that when you talk about the really high velocity levels, I don't know if you saw the Pfeffer blog that I quote, but he talks about an 180,000 average velocity, based on people only using ETH to pay for fees, and then obviously treating it as working capital and selling it as soon as they don't need it anymore. And that would mean, I think it's like 5 quadrillion in economic value would have to be transacted through ETH just to maintain the market cap at 50 billion at the time. So it's just like when you start plugging in these really high velocities, the issue is that the economics in terms of the transaction volume that has to go through it just stop making sense given current valuation. And I do think it's a really interesting point about the layer 2 solutions, the amount staked in layer 2 solutions. But I guess that the argument that the other side would make would be that even staking in a layer 2 solution, that's still a cost. Even if you're not it's still a scalability cost because you have the opportunity costs on your capital, and even that basically is probably going to get driven extremely low over time, or at least it's going to have the tendency to be driven extremely low over time as the layer 2 scaling solutions improve, which I guess would lead to a similar problem to the ones that they're discussed in the blog. But yeah, sorry, I'll let Eric speak about scaling now. But just wanted to make those 2 points.
No, that's interesting. And the velocity problem is interesting. I guess we might have to start thinking about velocity by the participants that are in the network. I mean, of course, some are going to want to buy Ethereum, use it as gas and sell it immediately, but there's also other areas where the velocity is way lower, like investors, people that are holding it, developers that want to use it. So there's always, different groups of participants there. But Eric, I'm definitely interested to hear your thoughts on scaling and where you think everything's going, because I'm doing a lot of work currently on this. I'm building a Serenity Ethereum report for next month, but I definitely want to hear your thoughts here.
So layer 1, that is hard. I just had lunch the other week with Preston and Raul from Prismatic Labs. I really love the stuff that they're doing. If you haven't checked out their Ethereum 2.0 client, you should. They already have their beta that they recently released, or their V1. But that's not to say, whenever you talk about the foundation moving the goalposts, there was a lot of difficulty in, the foundation's doing a good job now being able to fund projects and get money allocated. But for a while, it was not super great, and there wasn't a lot of transparency and a lot of connectivity between all the people that were working on layer 1. And as a result, some of these projects some of these, various companies and projects that were working on these clients and these solutions did not have a lot. Basically they'd be told, 1 week, here's the spec, and then the next week it's oh, here's the new spec, and they just kind of had to deal with it. And the foundation certainly improved on that, which is really awesome to hear. And they're getting better with allocating funds towards these various projects. But, I think that we're still, naturally a bit of a ways out. The sharding and proof of stake have been chatted about since DevCon 0. So these aren't trivial things. In terms of layer 2 solutions, when these things are going to be ready, payment channels have existed for a while. State channels are things that, there are a few different kinds of state channels. You have your application-specific state channels, and you have your generalized state channels. And the former exists. You can check out some example applications from one of my favorite companies working on state channels is Counterfactual. You can go check out their site, as well as their white paper and their code. Just go look up Counterfactual on GitHub. And then in terms of Plasma, Plasma is live, Plasma Cash. That's from Loom Network. I think that Loom has done some of the best work for being able to provide scalability. I mean, they've done a really great job with their crypto zombies and such in terms of bringing people into the space, but also on the Plasma stuff that they're doing. So if you're not familiar, they have their DApp chains, which are application-specific sidechains that use delegated proof of stake. And then they just finished up Plasma Cash, which is going to serve as a bridge for transferring value between the Ethereum main chain and these DApp chains. And so effectively what you do is you have somebody deposit money, Ether, into the Plasma contract on the main Ethereum chain, which will then reflect a change of value and create for them these non-fungible tokens, which are denominated which will equate to the or non-fungible token, which equates to the amount of ether that was deposited. So if you deposit 5 ether, you'll get a 5 ether token on Plasma, and this can be used for being able to bridge value to these dApp chains with a single operator running these Plasma chains, which are constructed in such a way that if you ever feel as though the operator who's submitting these block headers to the main chain is ignoring you, or they're trying to fake transactions, that they need to be, that effectively, as long as you keep track of your coin's history, that there's no way for them to steal money from you, and that you can do what's known as a Plasma exit. So there are no additional trust assumptions. Everything on Plasma uses the security of the main chain. It's just a way to be able to effectively bridge value between other, what would be like a side chain.
That's super interesting, Eric. There's a lot to unpack there, but a lot of great information for those who are new or to Ethereum. Layer 1 solutions like sharding are meant to break up the blockchain into what's supposed to be now 1,024 different chains. So basically, parallel computing, and then Plasma and state channels and stuff like that is layer 2. That's one level up on the pyramid. That is to basically, hopefully, create near unlimited transactions between parties where they close out on the main chain for security. Jose, I know you probably don't have too many contentious points on scaling, but I guess how do you think about scaling the timeline, or does this play into your velocity argument at all? Because in my mind, if you have unlimited transactions on Plasma, I mean, that really eats into, the velocity argument, or helps the velocity argument from the bear side. But, you always have to have that ETH stake on the main chain. So maybe not. But what are your thoughts here?
Yeah, I guess that goes on to the second argument about scaling, which is what people argue, that if we do have unlimited transactions, that will basically drive the amount of fees consumed down, because obviously the price per gas will go down, which will drive the total fees down. But I think what I argued in the blog was just that has to do with your view on the shape of the demand curve, and for
walk
me,
us through that, Jose. That demand curve on your post, for those that aren't here, is awesome. They could look up, Jose Macedo on Medium, go down to scaling. You could see the graphs. But Jose, definitely walk us through this. And Eric, I'm definitely interested in your thoughts on his response.
Yeah. So I guess the scaling argument, I guess, is kind of simple. The counter argument, it's just that if we're going to implement scaling solutions, that the fee required to process each transaction will drop. So even as the number of transactions processed may increase because of scaling, the total amount of gas fees could decrease, which would lead to a lower value of ETH. And for me, I guess that's what that assumes is a convex, so a price inelastic demand curve, because what you're assuming is that as you gain scalability, so symbolized by sort of a shifting down. So if you imagine hard to explain this without having the diagram in front of you, but if you imagine sort of a convex demand curve and then a standard supply curve, and you shift the supply curve down due to scaling, becomes more efficient. What you see is that in that case, what happens is that the total quantity of gas used goes down. On the other hand, if you imagine a concave demand curve, then the opposite happens. Any scalability gains symbolized by a shift down in the supply curve will lead to more total gas demanded. So yeah, and if you look historically, I guess it seems like the demand for most tech has followed a concave demand curve, and that it's price elastic. If you have more, if the price of tech goes down, you buy more of it. It's not like milk or basic goods, which even as your income rises you don't buy more of it. Even as the price rises, you don't buy more of it. Whereas with technology, as the price goes down, you tend to buy much more of it. And this has happened with computation over time, obviously and I put a history of that in the post, starting with supercomputers, moving to mini computers, and now obviously smartphone computers. Even as Moore's laws happened and the computational capacity has doubled, then every 6 months, that's been accompanied by a much greater than double increase in demand for computation. So I guess what I think is that even if scaling does happen, and we get to something approaching unlimited transactions per second, what we'll see is that while now, because the blockchain is relatively inefficient, only the people that really value decentralization can choose to use it. If you have more scalability, what happens is that more people are able to use, people that value decentralization slightly less are able to use the blockchain until eventually, as you reach unlimited scalability, you start getting to use cases that aren't even used in centralized databases right now because, they're not scalable enough, sort of thing. I guess so. That's my sort of logic on it. Is it doesn't seem to make sense to me that unlimited scaling will lead to less gas being consumed, but rather I think it makes more sense that it'll lead to more gas being consumed. I'm curious to see what Eric thinks about that, actually.
Yeah, it's super interesting. Eric, what do you think?
Absolutely. It's like we don't have a fixed user pool. The fact is that, as Jose was saying, the people that truly value this stuff can use it right now, but you don't. Not everybody has access, and not everybody needs to do every transaction on chain. And you can have scalability, but the fact is that as these layer 2 solutions do come up, you still will be settling to chain. It's just that you will be settling much more value. You'll be batching transactions, right? And it'll just allow more people to use the network. And so, right now we don't have. I think that the Ethereum blocks are relatively full at this point, and so people are a little wary of putting additional load on the network. So I think that as we see more of these second layer solutions coming online, that will have much more engagement. On top of that, like with second layer solutions, you don't have any real fee. We have little to no fees beyond setup and settlement as you're closing. And so it'll encourage a lot of people to use the network, and then you only settle when necessary. And so, yeah, I think you'll just open the floodgates.
No, that's interesting. And I guess the other thing that we're not really talking about here is that to even take advantage of these higher transactions per second from scalability or lower gas fees, we need, real use cases for this. So I guess, what do you guys think is the main use case for Ethereum 5 years from now? Games, smart contracts, decentralized organizations. I guess, Jose, then Eric, what's your top use case do you think that's going to come out?
To be honest, it's not something I have a very, settled opinion on. I think it looks like open finance are the ones that are. Open finance use cases are the ones that are seeing the most progress quickly. In terms of MakerDAO and loans on the blockchain and DYDX and all this sort of stuff, which makes sense. But I saw a great post today about how the sort of narrative on Ethereum and what it's going to be used for has kept shifting, even over the last 3 years. And so I think it's pretty difficult to tell what the big use case will be. I think the most obvious ones and the ones that seem to be gaining adoption quicker are the finance ones. But yeah, obviously gaming with Loom seems pretty interesting if you have layer 2 scaling open. But yeah, I think for me the finance ones make the most sense initially.
Yeah, I agree. I'm a huge MakerDAO fan. Full disclosure, I own it. I did a full blog post on them or full research report. And interesting part about MakerDAO is I think 1% of the total Ethereum supply is locked in Maker, and I think that can go to 20% or higher. Just my opinion on the model I built. But Eric, what do you think here?
So whenever I first got into this stuff, I was working on a decentralized identity solution for refugees, and quickly came to the realization that the vast majority of people who Ethereum is intended to assist with sovereignty and censorship resistance that may belong to areas where there's a corrupt government or a dictator, or they're under the thumb of some rule. A lot of them don't have infrastructure a lot of them don't even have smartphones. Like, they can't access a blockchain. And so in order to, when you talk about use cases and we want to be able to provide people with the ability to own their own things and, again, have sovereignty. But in order to do that, we legitimately need to expand the reach of existing internet infrastructure to be able to enable that. And so I'm a huge fan of all of the businesses. I'm super skeptical of mesh networks, but I will totally support that, or anything like LoRaWAN or anything along these lines to be able to help access the things that I think are going to be, most successful are financial tools. It is it's kind of an extension of the credit system. Except you can't just, I think that there actually will be, believe it or not, I think that there will be like a reinvention of the existing banking system to allow you to be able to hold crypto. And there will be like a second layer, like the Lightning Network, that will mimic that banks are very much used to. Like banks do operate between each other, and they have money. They have basically subsidiaries beneath them to have money transmitters to be able to give money to various customers or their branches and such. And I see like these networks evolving in a way that's very conducive to the existing system. But that I'm really skeptical of whether or not it will. I know that I'm taking this a little further, but I'm really skeptical of this idea of like crypto replacing money as a whole. I feel as though the government wants to do away with fiat in general. But I think that, it's like right now, if you want to hold gold, you can hold gold, but there's no infrastructure for it. And so this is going to be an alternative store of value that you can have in terms of the financial tooling. But I think that we're going to still have fiat for quite some time. So long story short, I agree with you all, financial tooling.
That's super interesting. And I guess, so basically what you're saying, Eric, is that we need to get cheap Android devices in the hands of everyone around the globe before we have, global adoption of crypto.
Well, not just that, we need to have like actual infrastructure. Like a lot of these places have no internet. And so maybe with Elon Musk's like global Wi-Fi satellite network or something along these lines, that'll be able to assist there. But yes, effectively, we can't even get people on because they don't have the means by which to access a blockchain.
No, it's interesting. We covered, or my previous job before 51%, I was on the equity research team. We covered a lot of the carriers and, everything from 5G to mesh networks and the infrastructure and the data centers, the whole 9 yards. And mesh networks are always the go-to, but after, you share your Wi-Fi or internet with like more than 2 or 3 hops, the signal just totally degrades. But, I guess that's what happens there. But I'll play devil's advocate here. Why can't we just use Bitcoin for all of this? It works. It's a financial tool. You don't need a crazy fast internet connection. Why won't we just use Bitcoin? If we're betting on the financial applications in crypto, why don't we just use Bitcoin and forget about Ethereum?
Yeah, I think there's much more limitation on what you can do in terms of the Bitcoin, scripting language than what you can do with Ethereum and a Turing complete programming language. And I think that is a big deal for a lot of financial applications that are fairly complex. But yeah, I think Eric will probably have a better insight on this in terms of the technical part.
Yeah, Eric, I'm interested in your view here because, Bitcoin is easy in its understanding and the use case and how it can be used, but it's limited in that you can't build. Well, Jimmy Song will argue you can, but we've yet to see it. You can't build real applications. Like there's no MakerDAO on Bitcoin that's working and is, actually being used. So do you think that the financial applications built on Ethereum will outweigh the store of value and network effects and Lindy effects and everything surrounding Bitcoin for financial applications?
So I am really like Bitcoin. But there's a lot of money in Ethereum. Like Coinbase made more money from Ethereum than it did from Bitcoin. And there's a lot of people that made a lot more money from Ethereum than they did Bitcoin. And with all the ICOs and all of that, basically, like people have a lot of money that's riding on the Ethereum network, not necessarily the Bitcoin network. And you can see this with additional like statistics on who's developed, like where all the developers are going. Most of them are centering around Bitcoin and Ethereum, but Ethereum, like Bitcoin has a much smaller, core than I feel like Ethereum does. And so I think that you certainly can build a lot of these things on Bitcoin. I think that really, like, the vast majority of what we're going to be using in the future is legitimately multi-sigs. And this is just a security deposit that one or multiple parties agree to, or well, it's more than one party agrees to. And they have some specific terms on the settling and the closing of this multi-sig. And you can build on top of that. Like I think that putting everything on the main chain can be a real drain on it, which is part of the reason why I'm a huge advocate of layer 2 solutions. So I think that you can do the vast majority of these things on Bitcoin. It's just a matter of where the vast majority of the infrastructure is held. Like on Ethereum, you have all the computation and storage. Well, I mean, like, hopefully you don't have all this storage on Ethereum or the computation, but you have that option, right? And you have it much less so on Bitcoin. But I mean, like, if you talk about somebody who's using Ethereum to build a decentralized application, they're not storing things on Ethereum. They're storing it on IPFS or something, and they're storing hashes, right, on Ethereum. And so so like we have all these integrity checks effectively, or these checkpoints. So I think that really diminishes, the argument of using Ethereum over Bitcoin. But, like I said, there's a lot of people have a lot of money that's come from Ethereum, and they're going to continue pushing a lot of those resources at it. Whereas Bitcoin kind of just, like, Bitcoin doesn't, there is no, like the consensus of Bitcoin is like what, Blockstream? And it doesn't have 1,000 employees, right?
That's a good point.
So there's a lot of money being thrown at Ethereum, much more than Bitcoin, in my opinion. So people are going to, I think that, and with the companies like Coinbase and such that have that principally Coinbase and Consensus that have these enterprise partnerships at this point. Like, I don't know what enterprise partnerships Blockstream has, but Ethereum certainly is better poised for that.
That's interesting, Eric. It's a lot to unpack there, but a lot of great info. And, it's interesting because a lot of the projects built, well, not a lot, but, we're just talking about MakerDAO, and they're going to roll out basically multi-collateral DAI. And, probably, I don't know, Bitcoin is probably the first one that they're going to support other than Ethereum. So you're seeing, applications kind of link back to Bitcoin, which is interesting in a way, at least for MakerDAO. But I guess my last question for you, Eric, on this topic, and Jose, feel free to chime in if you think, but, Eric, why do we see so much on Twitter and on the media about building on Bitcoin, but yet we're not seeing any like real applications at all? Like, I know Bitcoiners will knock Ethereum for not having viral dApps, but like, I don't see any apps on Bitcoin. So like, where does this come from?
I mean, so sadly, a lot of the figureheads of Bitcoin that are on Twitter are like, they really shouldn't be talking. Like for instance, one of the director of research, Andrew Polstra for Blockstream, I chatted with him. I had like a 4-hour chat with him a few months ago. And he was the most knowledgeable person I've ever sat down with in the crypto community on cryptography, took everything very seriously, like did his email from the command line. He had a YubiKey for unlocking his computer. And like he took everything very, very, very seriously. And I think that effectively the reasoning behind this is that a lot of Bitcoiners are very, very jaded, or they are just like closed-minded. In fact, if Greg Maxwell had been a little more open-minded, I doubt that we'd even have Ethereum, because we'd be able to do all the things that Ethereum does on Bitcoin. And so, people are working on these Schnorr signatures. They're working on scriptless scripts. They're working on a lot of things for Bitcoin that mainly revolve around, I mean, not necessarily app utilization, but being able to, I don't know, harden it or give it like a strict set of additional features. Whereas in Ethereum, I feel like it's like, let's just try absolutely everything and see what sticks. the thing about like Ethereum is that I got contacted by a company the other day that's like, oh, we're doing AI on Ethereum and we're doing medical, we're doing aggregation of medical records using homomorphic encryption and big data and blah, 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 blah. And I was like, these guys are so full of it. They have no clue what they're doing. And they're
Battle
just
of the buzzwords.
Yeah. And somebody was like, do you know anybody that would like that? So I was being reached out to by a friend to see if I knew anybody that'd be interested in being their CTO. And I was like, this sounds like a terrible company. And they've raised too, they've raised like a non-significant amount of money. And, and so like, I think that Bitcoin is just like very, very conservative and they just want to maintain the idea of the store of value. I don't think they want to be applications on Bitcoin. Like I've played some of the games like there's this thing called like BitCrush or something like that, which is like it's a provably random game that allows you to gamble like with Bitcoin. But other than that, like you can pay for things in Bitcoin. Like I don't think people are trying to build applications on it.
Jose, what's your take?
Yeah, I think a big part of it is that Bitcoin, I don't know which came first, whether they chose to brand themselves as this or whether the brand came as a result of them not moving, but it seems like sort of the store of value brand that they've got going and the thesis behind investing in Bitcoin also relies on them being sort of slow moving and not changing much and being predictable. And I think probably because Ethereum emerged as the true and complete smart contracting platform, they also, they had to fill that niche of being, because the narrative sort of changed with Bitcoin. It's quite interesting now that they have the store of value narrative in which, they're scarce, it's secure, it's censorship resistant, it's self-sovereign, and that's sort of all you need to be a store of value. And it's also the digital gold idea, because and something I've been thinking about recently is why is it that we assume that Bitcoin, Monero, Zcash, these can be stores of value, but something like Ethereum that has utility couldn't be, because I think digital gold is sort of the example that people use as store of value, because gold is sort of useless. That only a very small percentage of gold is actually used in industry. People assume that the digital store of value has to be useless as well, but I don't see why that's the case. Because we have and have had many stores of value throughout history. And at some point, wheat was a store of value. Nowadays, we have equities, we have real estate, we have fine art, we have all sorts of different stores of value that actually have a use. And so, yeah, I guess I find the dichotomy between store of value and utility and the thesis that have emerged sort of weird, because I think store of value is just a utility. It's certain characteristics that make something a good store of value, and I don't see why sort of the future, the digital store of value, has to match our current store of value in gold, which something I've been thinking about recently in terms of the store of value thesis.
So I may have been out of the loop, but like, who's saying that a digital store of value has to be useless? Because I think that Ether is a store of value. Can you elaborate on that? There's something that I can read?
Yeah, so sort of a lot of the, I'll definitely send you some links, but a lot of the thesis on Ethereum seems to be that it's going to be high velocity. Because of its utility, it's going to be high velocity, and that's going to make it a bad store of value by definition, sort of thing. And then the theory on Bitcoin is that because it has less use, it's going to be lower velocity. People are going to hold it, similar to real life stores of value, and so it's going to be a better sort of store of value. And a good blog about it actually is by Multicoin. I think it's called The Path to 100 Trillion, something like that. And he kind of goes over the three main thesis, and one of them is the store of value thesis, and people who are backing like Decred, Monero, Bitcoin, and stuff like that. And yeah, they have this belief that protocols will be thin, as in smart contracting protocols, whereas the ultimate non-sovereign store of value is actually what's going to capture most of the value. But I just find that, I find it a really weird argument to make, I think, as you pointed out as well.
What do you guys think about, I'm sorry, go ahead.
I mean, like, I view one of the main things about having a good store of value is it being like a predictable supply that's increasing over time, or maybe it isn't increasing and there's a fixed amount of it. but the idea is that you just can't mint things like on the fly. And as you mentioned, like you had salt in the past. There was even this place that used like these giant rocks.
The yap stones.
Yeah. And you had wheat in the past. These, I mean, like those were all medium of exchange. Mediums of exchange in terms of like store of value. Gold does have fixed, limited utility in terms of like we use it inside of some consumer electronics. And also, it's shiny and pretty and it feels good in your hands. But I mean, like, I think that it's completely reasonable to have a store of value that you can have, which is, I mean, like, you have the option to not use it, right? Like it's all on you. And if everything's going to be staked in Ethereum at some point, like, then you could argue like, oh, well, that is kind of fitting that narrative of there being very low velocity, even though we might be trading derivatives on top of it, right?
Yeah. That's interesting. I guess if we zoom out, guys, why can't Bitcoin be the global store of value, and why can't Ethereum be the crypto decentralized platform to build applications, smart contracts on? Like, why can't we just be okay with the two? And to be honest, I think the Ethereum community is okay with that. I think the Bitcoin community is not okay with that.
Yeah. Okay. Yeah, I think that it's very difficult for a smart contracting protocol to succeed at being a smart contracting protocol without also becoming a store of value. Because the network, in order to be censorship resistant, in order to be secure, it needs to have a fairly high market cap. Especially in the case of proof of stake, but also in the case of proof of work. So I don't think, that's one thing. I don't really think it's possible for Ethereum to succeed as a smart contracting protocol and not succeed as a store of value as well, which is something that actually John Pfeffer points out, right? That if Ethereum is really high velocity, then eventually you'll need another asset to secure the network, because there won't be enough value captured by ETH to actually secure the Ethereum network. So yeah, I think I don't see how Ethereum could succeed as a smart contracting protocol without also being a store of value. In terms of Bitcoin being the global store of value, I see that as a possibility, definitely. But I don't think it's a given just because it doesn't have utility, it doesn't change, that would be what makes it the global store of value. I think it's sort of naive to think that the store of value that we have digitally will look exactly like the one we have right now in real life.
That's interesting. I want to get back to your post, Jose. Let's go on to one of your last points. And one of your last points is that basically there's going to be a lot of competition in the space from other smart contract platforms like EOS, Definity, Neo, Tezos, and other smart contract platforms, and that this base level protocol, Ethereum, could just get commoditized away. So walk us through your argument here and what you attempted to argue.
Yeah, this is actually a really interesting one. Vitalik responded to this on Eth Research, and I've actually responded to him trying to get his thoughts on this. Because obviously, with in the traditional markets, this isn't really an issue because competition and forking is much more difficult in that you have a lot more. Obviously, you have intellectual property, you have non-competes with your employees. You have way less interoperability between protocols and all that stuff. So this becomes a way smaller issue. But I guess what the article rests on is the fact that forking and creating a competitor is a zero cost activity. When in reality, I think it's definitely not a zero cost activity. And I think, that there's been several attempts to model this, but I think one of the ways to think about why it's not zero cost is Metcalfe's law, in that if the value of a network is proportional to the square of the number of connected users, then, two split networks will necessarily be less valuable than one network that has the same number of total users, if you know what I mean. So I think that the argument basically relies on the fact that if you have infinite competitors, it basically starts to look like a perfectly competitive industry, and you have zero economic rent, and so Ethereum has no pricing power. Whereas in reality, I think that there's significant network effects to being the dominant smart contracting platform, and these range from users to infrastructure, as Eric mentioned, to developers, but also just to security, which is something that's sort of which are dynamics that are difficult to quantify and model because they've never had to be modeled for the traditional markets. and what is the value of these network effects. And I think in terms of the specialization argument, which is another one that's made, that you're going to have many different use cases for many different chains. And so, if Ethereum is a general protocol, it's not going to suit every use case, and someone's going to come along and either fork it or create a competitor that does some specific thing better. I think that the main competitive advantage of blockchain is the decentralization, and I do think that these different use cases make a lot more sense on layer 2 solutions, as Eric was talking about, than they do on a different blockchain. I think Loom is from what I understand is basically doing EOS on a layer 2 scaling solution, and to me that makes it makes much more sense to have that scalability on layer 2 and benefiting from the decentralization and security of the main chain than to have it on a whole separate blockchain. And again, it's something difficult to see because we don't yet know what the market value of decentralization is. In some ways, I actually think the value of decentralization is something that will take several years and probably several hacks and collusion scandals and all sorts of things with other chains until we realize the value of it. Because right now, for someone launching an ICO, they're looking at EOS, they're looking at Ethereum. They see that EOS is more scalable. They might want to launch there because the benefits of decentralization are not really well understood, it seems. So yeah, I guess that's my thoughts on that argument.
That's super interesting. Eric, what do you think about competing platforms and forking and the future here?
Another reason why I wanted to get involved in layer 2 solutions was so that way I could undermine all of the competing platforms by just making them side chains to Ethereum through Plasma.
Yeah.
Because that's something that can totally happen. And as Jose was pointing out, like Loom is doing DPoS with their app chains. And I think that, being able to secure the main chain is very, very difficult. You need to have an insane amount of, inertia, or you need to have a very solid foundation. It's very difficult to bootstrap a new chain at this point. So, I mean, my head's in the same place.
You also have to think about forking away the network, or not the network, but the developers and the entire community, which is extremely hard to do.
Yeah. And the thing is that I think that forking is going to become, it's something that can totally happen continuously, but it's not, but like once you have like a certain amount of inertia, and once you have a certain amount of, like, it's just going to be very, very, very difficult. We're never going to have another DAO fork again that was as contentious as the one that we had. Barry already spent his money, right? But yeah, I mean, like, I think that I think that Ethereum is going to be very, very stable in the future. I am very worried about the upgrade to Ethereum 2.0. I think that will be, so I know I said that we'd never have a huge contentious fork, but I think that'll be probably that would result in one.
That's interesting. I always thought that Vlad and Vitalik would eventually have their own Ethereums, but they came together on Jasper, which is now Serenity, and that kind of blew up my argument. But
kind of, because we're not doing Vlad's correct by construction. That's like, I don't believe that's going. Yeah, that's not the case. I think that our chain is going forth with that, kind of. But basically, like, Ethereum wasn't meant to scale this quickly. It was basically put into this position of like having a bunch of spotlight thrown on it. And now there's just a bunch of resources being put into seeing that it can scale. So, we'll see what happens. I personally don't have a lot of faith in a lot of these other chains, simply because of the amount of Ethereum's got a lot of ground on them. And I do think that there are some of them which are very heads down and focused that will be able to provide value, such as like Definity or Hashgraph. But I don't think that if we're looking like what's going to be the one main thing, I think that it's going to be Ethereum.
That's interesting. So, I just put out a Tezos deep dive, and I tried to make an argument where Tezos is one of the only viable Ethereum competitors just because of their ability to change, how they handle proof of stake, their on-chain governance. I thought they had a lot of cool, basically, features that allowed them to evolve fast. I don't know if I sent you guys the report, but but one of the points is that Tezos is going to have to compete not with Ethereum today, but with Ethereum of tomorrow, which is Serenity. So, Ethereum's set to roll out proof of stake, sharding, EWASM, Plasma, hopefully even rated network or zero knowledge snarks, ZK snarks. How do you guys feel about the timing of Serenity? Do you really think that we're going to have full Serenity by, I think it's 2020, or what do you guys think here?
We keep moving the goalposts.
Yeah, we keep moving the goalposts. I mean, when I got in, it was 2018, the goal, So I think it was summer 2018, actually, the goal to launch this. Yeah, we keep moving the goalposts. But I do think that I totally agree with, I think, what both of you said, that at this point, the network effects of Ethereum are quite underrated by the market. I think, the number of developers, I've looked at several different measures, GitHub activity and stuff, but it looks like basically something around 10 times more developers working on Ethereum than the second biggest blockchain after it.
Well, not via the CoinDesk visualizer.
Which one was that? Must have missed that.
Oh no.
Loaded question, Eric, or not?
Silly. It's very silly. The CoinDesk made this thing where everything's measured against Bitcoin, and Bitcoin's the golden child where everything's 100%.
Yeah, I don't know why they overlooked the fact that so much of Ethereum's development happens off that one repository.
Because it's CoinDesk.
Yeah, I mean, I think they did great work on the visualizer, and they're pushing the bounds there. But that was definitely an oversight. There's no doubt about that. I mean, just going back, though, to the timeline, I mean, let's say that it doesn't get done by 2020. Let's say Ethereum fully upgrades by, let's say 2025, for argument's sake here. That's a long time. That's 7 years away, or a little less. Isn't that plenty of time for stuff like Tezos and Definity? And I just had Emin Gunsur on. He was talking about what he's doing with Ava. Isn't that so much time for other platforms to gain developer mindshare? And I say this in not just Ethereum mindshare, but the mindshare of like the millions of global developers that aren't even in crypto yet that want to come in. I mean, doesn't this open the door with these extremely long timelines?
Network effects, man. Like businesses that are looking into building this stuff are looking at principally Ethereum. It's Ethereum or Hyperledger. You very seldom hear about businesses building on EOS or anything like that. Tezos is so young. It's businesses like things that they want to be able to focus on, leaders in the market or category kings, and like basically things that have proven themselves and that have a lot of tooling, infrastructure support, and you can come out with Ava and Avalanche and all that, but it just simply doesn't have the support of Ethereum. And so it's going to take a few years for these alternative blockchains to even get their foot in the door with any business. Businesses are still doing proof of concepts, right? There isn't an insane amount of traction in the blockchain space. I think it's going to be a few more years until we see real businesses begin to actually adopt this stuff. And you can point at, Google's got their BigQuery stuff, and Microsoft's got their Cocoa stuff. Azure lets you spin up an Ethereum node, or AWS lets you spin up an Ethereum node. There are some businesses doing things, but I think that it's very difficult to defeat those effects at this point. I think that if you're a coder, you probably hate JavaScript, but we all use it. And it was just this virus that kind of sprung up as the de facto thing that you use to make web applications, and then it just stuck, and it was terrifying, and now here we are. And so I think that a very similar thing is happening to Ethereum.
Super interesting. Jose, what do you think?
I think obviously the longer it takes, the more doors open for other projects to sort of capitalize on that and steal potential clients from them. I mean, just from what we're seeing at Amazix, lots of the projects that come work with us compared to a year ago, a lot more of them are launching on alternative blockchains, whether it's Neo or EOS, or whatever it might be, especially when you have, EOS having billions of dollars to put into grants and seeding the ecosystem. And the same thing, Definity's raised an absurd amount of money. I think the time that that Ethereum is going to take to launch will give these projects more time to catch up, undoubtedly. But I still do think, though, that people are underestimating, like Eric said, the network effect of the sheer amount of developers and brand name and consensus. All that contributing towards Ethereum, I think, is being very underestimated right now.
That's interesting. And I actually owned some NEO a while ago. I don't own any anymore, but what I thought was a cool thing at the time of the NEO wallet was literally right on the NEO wallet, you could participate in an ICO just by clicking a button. It was just so easy to use. But getting back to what you guys are talking about with competing platforms, when you have centralized type or more centralized blockchains like NEO or EOS, where there's 15 nodes, 21 nodes, whatever it might be, the scalability is way higher. But the thing I think about is you can't technologically improve that because the base protocol will always be set like that. Ethereum's very decentralized and we can innovate and scale, but you can't go from centralized and scale up into, decentralization per se. So I just have a problem with EOS and NEO in that I don't think that they'll ever get around the problems they have with their centralized nodes. So I think I'm kind of arguing myself here, but I don't think that more time would help them. But I'm wondering what you guys think here.
I'm be interesting to hear Eric's thoughts, but I'm not sure about that because I do think NEO's now, they started off obviously very scalable and quite centralized, but I think they are expanding the number of nodes available. And I think the plan is to have something like 10,000 in the next few months, something like that. Don't have the exact details on the roadmap, but I'm not sure whether it isn't possible to go from scalable to decentralized, or whether it would just be much more difficult. Be interesting to see what Eric thinks.
Yeah, it's an interesting argument. So basically, instead of arguing we're going from decentralized and scaling up like on Ethereum, we're arguing that more centralized platforms like EOS or NEO, while they have much higher scale now, but they're more centralized, they can become decentralized over time. Eric, what do you think about this? I think you probably agree with me, but I'm interested.
Dude, after seeing NEO, so I'm not the one who held NEO, but
but it was early in my crypto career.
I didn't know what I was doing. My friend said it was going to go to 50x.
They said it was the Ethereum of China.
Oh yeah, that's great. I've been seeing a lot of copycat projects from Asia. And I'm just not really impressed by any of them. NEO's network went down multiple times. I remember I was just checking to one day to be oh, what's going on with NEO these days? I haven't looked in months because last time I had heard about it, somebody was oh yeah, one of the nodes failed and they couldn't recover for 3 hours. So I go to their block explorer and it's oh, guess what? Same thing. So I mean maybe they're getting their stuff together. Personally, I haven't kept up with it. EOS has certainly got a lot of money. I get the whole DPoS thing, and I think that it's very reasonable, and I think it's something that people can really get behind because the whole idea is hey, if there's a terrible mistake and everybody wants to get rid of it, we can totally do that. And the idea behind the 21 validators is that with mining pools or any sort of quote unquote decentralized ecosystem, Dan was saying that at most there would be maybe 21 participants. So I can see the points being made there. You can go from centralized to decentralized. That's exactly how Bitcoin started, with a single node, right? You have to go from centralized to decentralized. You don't start decentralized. That's very hard, or kind of impossible.
I guess architecturally though, rather than practically, can you start off centralized then go decentralized?
Yeah, with the number of validators, can you decentralize validators over time? Could EOS ever have 2,000 validators?
Yeah, but I doubt it could, but I doubt that those guys at the top are going to want that to happen.
They'd have to vote it in, right? And vote against their own self-interest right now to do that.
Yeah.
Yeah, because then they have to split up the money they make on validating transactions.
Dude, it's nice being an EOS validator right now, I'll tell you.
I don't doubt it. But Eric, I want to go back to, and I'm probably misremembering your email, but one of the points you brought up was you're a little skeptical on some of the actors and the players in the Ethereum community and, how some of these projects are panning out. What do you mean by that? And hopefully I'm remembering right here.
I might have said that, but I definitely am skeptical about everything. And
what are you most skeptical about in Ethereum right now? Is it the timing? Is it the scaling? Or is it the projects? What is it?
I mean, the scaling is something that is being solved, particularly on layer 1. Layer 2. I really wonder about if anybody. So I view the entire space as an echo chamber. And something that I urge people to do is to go out and get out of the building and stop just talking to people in crypto. Because what's the value proposition that is going to get your father, your friend to start using this stuff? Like, I live in the United States. The system works pretty well for me. I don't have to worry about my bank account being censored or having my funds being absconded by some, government actor. Like, this is the thing that I'm most skeptical about is what value are we truly trying to provide here? And what's going to get people on to use this stuff? Like what are we actually giving people here? Coming from a Westerner.
Yeah, it's an interesting point. I mean, Jose, what do you think about that?
I mean, it's something something I say all the time. Basically, I totally agree. I think that there's a huge echo chamber in crypto, and even with security tokens, you're seeing the same thing. Sort of huge hype, a lot of equity, which I guess is the fact that every single sort of project doubles up as a multi-level marketing scheme because most of your users are also investors in it. So I guess that kind of contributes to the echo chamber a little bit. We've sort of never had that dynamic before. But yeah, I totally agree. I think I think we're still having trouble sort of defining what the key value proposition of this will be to the average person, especially in the Western world. And I think that decentralization is an interesting one because you obviously have these chains doing trade-offs and stuff like that in terms of decentralization for scalability. And I'm sort of curious to see what is it that's going to prove the value of decentralization. Because it seems like there's got to be some kind of event that will precipitate people realizing the value of decentralization. And then to me, it seems like something like that will require the other chains to actually gain some ground. It will require EOS to be processing a fair few transactions, and then for there to be a high-profile collusion scandal. No,
that's interesting. I mean, I thought that all the hacks that we've seen from Equifax and all the other ones would have driven people to know the value of decentralization, but it hasn't so far.
No, yeah, I agree. So it's an interesting one. I'm not sure. I agree. I think we've got to do a better job of doing that as a space.
That's interesting. And guys, I have one of my last questions for you. I mean, the SEC kind of had its first civil penalties against two ICOs. I think it was Airfox and Paragon. What does this mean for the Ethereum ecosystem? Are all the ICOs going to have to refund all their money? Because that would be disastrous for Ethereum. Or is this use case now gone? What do you guys think here?
I mean, there are people that are registering to do ICOs with the SEC, but a lot of companies are now just moving on to equity raises because it's become such a nightmare. I think that the SEC they also just fined the guy that came up with Ether Delta $400,000, which I think is it shows that how do you do that? He's not running the exchange. It's a decentralized exchange.
Yeah, that was interesting.
And so I think that the SEC is still very confused, and they're just going to start making examples of things to try and dissuade people from basically participating in money raising or trading or anything like that they can't control.
Yeah, I mean, the random selective regulation is not helping the space. I mean, everybody wants clear-cut regulation that applies to everybody. But Jose, what do you think?
We have a lot of we actually have a lot of experience with this because so there's sort of many projects that we work with that have been affected by this, either because they've had utility tokens that may that are doing a raise and now they're unsure whether they'll qualify as securities or not, or They have token models that didn't quite work out, and they might want to restructure securities. But it's something that I find really interesting, I guess. But I think one of the main issues is that a lot of these utility tokens were actually just evading securities legislation. There's certain token models like staking without actually providing any use to the network, without actually providing any work to the network and getting paid based on that, where that's just a way to get around dividends. Or even for instance, token burns is another interesting one, because a token burn functionally is very similar to a dividend, in that you're taking a certain amount of excess cash flow and you're distributing it back to token holders, except one is done through deflation and the other is done directly through a dividend. So I think, what we try and do at Amazix, I guess, work with these projects on their token economics to make sure they actually have some token economics that makes sense, and that the utility token makes sense. Because I think what we saw sort of a year ago is everyone saying, all right, we have this network, and to use the network, you have to use our token, which is this medium of exchange token. And that's our token model. And I think what Velocity has done, rightly so, is sort of killed that token model and show that doesn't really make sense. But some other token models do make sense as utility tokens. Work tokens like Augur or even Steam, despite being a pyramid scheme, make a lot more sense for the crypto use case, or even a discount token model, something like that. So what we're trying to do is, I guess, work with projects to either reformulate their token economics so that they're actually a utility token, and that the token has a genuine utility on the network, and it's not just evading securities legislation. And in the case that there isn't an obvious use case for a utility token, which will happen some of the time, reframing it as a security token and helping them with launching that. But yeah, I agree that the SEC has, and the regulators have some learning to do. But I also think that there's a lot of faults on projects' parts, which are just issuing sort of utility tokens that have no utility.
That's interesting. So last question for you guys. I just listened to Pomp's podcast recently. He's got a great podcast. He's really engaging with Murad. And basically Murad argued that Bitcoin will go to I forgot the number. I think it was $1 million a Bitcoin or something. Do you guys think that we're at the bottom of the bear market for crypto or Ethereum? And what do you think is the next catalyst? Use cases, ETFs, Serenity? 2 minutes or less. Eric, let's start with you.
We're not at the bottom. Things will get worse, and it'll be good. A lot of funds are coming up on 1 year. Whenever this hype really started, there's going to be a lot of redemptions. They're going to have to deploy a lot of capital. Do you know that Litecoin still valued $2 billion? Litecoin has no use case. It's at this point, it's completely useless. We're not at the bottom of the bear market. It's gonna get much worse. That's
things like that gets me bullish, Eric.
Yeah.
Jose, what do you think?
I actually agree with that. Sadly, I think that I've studied a lot of sort of financial history to sort of try and learn what a bear market looks like, what a bull market looks like, because there's only a limited amount of personal direct experience you can have. So, and what I think is that there's still a lot of people saying institutional investment coming next month. The bull runs is coming soon, and I think that the opposite of a bull run and of excitement isn't fear and FUD. It's actually indifference. So I think we need to get to the point where people have forgotten about crypto, where no one's talking about it, where that was a failed experiment sort of thing, until we see the next bull market.
Super interesting. Well, Jose and Eric, I will link to your respective Twitter accounts and companies if they're there on the show notes and all of the articles we mentioned. And it was a pleasure having you both on. It's great to have you.
Thanks very much for having me on.
Great chatting.
Thanks so much, guys. Hey, everyone. Thanks for listening to the podcast. Please rate and review it to help other people find the podcast, and visit 51pct.io and enter your email to get access to our crypto research.